Let's start with you. The overall sentiment in the market in the negative, and that's partly due to that disappointing 7-year auction. And you know what? You can't help but feel that these auctions are having greater sway in markets nowadays.
Yeah, I think that's fair, Haslinda. I mean, look, at the start of this week, I was kind of saying, look, there's a massive auction schedule this week. How much do we care? And I'll admit that most of my team were like, nah, not really a big issue. You know, it's bigger about PC later in the week, non-farm payrolls next week. Then we got the Fed coming up, that kind of dot plot, the new projections. So they're the kind of bigger issues. But it was interesting. We dismissed it because we said, look, the backdrop picture is we think yields are going to continue to go higher. And it is this idea that global yields, and particularly US yields, have more to go. We've talked about this a lot, Haslinda. The idea that there's still rate cuts priced in the US does not seem to make much sense. The base case should be no move either way, but hikes need to be at least a possibility on the horizon. And until we get more into that narrative, yields still have higher to go.
Rates. Yields tend to go higher, expected to go higher. How high can they go? And you know what? It's not just in the US, it's elsewhere in the world as well.
Yeah, look, I think it's a global theme. I think that, you know, we have not had the recessions around the world to control the inflation we let get out of control. So until we do that, services inflation will stay sticky. And now we're also seeing the volatile goods component of inflation also kind of reinflate via commodities, via shipping dynamics. So look, the inflation narrative is not under control. So central banks can either tolerate higher inflation, which is more dangerous down the line, and that means that we just delay any recession, or they can get serious about it. I think in reality they're going to try ignoring inflation until they're suddenly forced to get serious about it at some point in the future. But the backdrop is yields probably need to keep on going higher.
All right, Stephen, let's get you into this conversation. It is about FX, it is about the yen, about the yuan. Let's start with the yen. When will intervention come in? They say 160 is the level we're looking at right now. I mean, it's already breached that level that prompted that suspected intervention the last time.
I mean, like, interestingly or boringly, now it's very similar to a year ago. It's still about higher US yields, higher for longer. I mean, like, even if you get one cut or two cuts in the second half of the year, it doesn't mean that the Fed will just keep cutting. Probably that's it. So higher for longer will probably stay for longer, if that makes sense. So that's why the broad dollar resilience, at least if not stronger, is going to stay. And hence, Asian currencies, every single one of them, except probably Singapore and Hong Kong, will remain under pressure. So for now, obviously, market has come a little bit after that suspected BOJ intervention, but you can see that basically rate differential is still huge, whether it's US Japan and US China as well. So that's why you see dollar yen slowly crawling back towards 160. Now, of course, if the June FOMC doesn't provide anything, any hint of a fast cut early on in the second half of the year, then probably that could be a trigger for dollar yen back to 160. And it will be very interesting to see what the Bank of Japan will do.
Stephen, that's specifically about dollar yen. I'm curious about your views, the idea that let's just take out the dollar component. Do you think in a world where the Fed, maybe they start cutting rates, maybe the dollar turns lower, how does yen do on the crosses? Do you think that yen will still be higher beta to Fed rate cuts, or will it continue suffering on the crosses against other Asian currencies, even in a world where the Fed is cutting rates?
I mean, it's still a rate differential story. So if we look at yen crosses, it's going to be like Japanese yields versus the rest of the world. Now, the thing is, yes, Japan has started hiking rates. They may even hike another 40 bips according to our economist forecast. But 40 bips in this world, it's basically so little. It depends on whether the other major currency is talking about. If you say euro, the ECB, or the pound, the BOE, whether they cut fast enough relative to the yen, of course. Say if the ECB really cuts in June and cuts further, then yes, for Euro yen, probably the yen could perform better, but still, like if against other higher yielders, let's say the dollar, then of course it's still going to be under pressure.
Stephen, we keep waiting for the BOJ to do something about the yen. The thing is, it's getting even more difficult for the BOJ to take action. We heard from Yellen saying, you know what, that shouldn't be the first port of call in terms of supporting the currency. And we had G7 finance ministers also saying they're not tinkering with the FX movement. So where does it leave the BOJ?
I mean, it's very interesting. If you look at the recent comments, whether from BOJ officials or like from the Ministry of Finance, they've been admitting like quite explicitly that a weaker yen is basically causing problem for import inflation. Now, that means in terms of monetary policy, it's possible that they may want to hike earlier and probably slightly faster. But it's still the Japan that we're talking about. So even though if they can hike earlier and faster, it's not going to be really fast. We're still talking about below half a percentage point. Now, at first, they may help the yen a little bit upon the announcement, but still, at the end of the day, when market look at the broad rate differential against the U.S., against the other major central banks, it's still very low. We're still talking about half a percentage point policy rate in Japan, even if they hike. So that's not going to be enough for the Bank of Japan to support the yen. So we expect if that continues, then intervention may have to come back again.
And Mark, you raised your eyebrow when I said that it is time for a correction in the market. I mean, look, 23 of the past 30 weeks have seen an increase in the S&P going straight up. It is time for a correction, isn't it?
You're right, Haslinda. Look, you know what? I'm just disappointed by this TV hit today, and I'm going to tell you why. First of all, I agree with everything Stephen says, which is no fun. I want to have a bloody argument with him, and I completely agree with him. He's absolutely right on everything he said on the yen, the BOJ. So that's ruined one part of the fun. And the other part of the fun is, you know what? My most succinct, clear markets view today, I'm stealing from you. In the break, when you said we've had 5 weeks, we're due a consolidation, it's nothing more than that. You're right. Let's not be too dramatic. We're due a bit of this consolidation. Overall, the bull market will go on. Maybe it'll take a couple of weeks to this consolidation, but it's nothing dramatic. We're due it. You're right.
But isn't there a key event to be looking out for? NVIDIA stock split, for instance. Some say that may move market, that may impact sentiment.
Sure, but why is that going to change the overall narrative? You know, that's going to cause some short-term volatility.
This is one stock that's been driving the market sentiment.
But you're right, and maybe that's going to be the catalyst for some technical reason. But I just don't see that changing the narrative. NVIDIA's earnings were not only good, but their forecasts were good. And from the micro level, the AI bubble, and I do think it's a bubble, is not ready to implode yet. I do think that'll be challenged at some point in the future. But we've got at least another few months to the next earnings cycle to challenge it again. So I think overall, the bull market has another few months in it. Does that mean that this consolidation can't last a couple of weeks? No, of course it can last a couple of weeks. But the backdrop's still good, and I think dips will ultimately be bought in this consolidation period.
All right, hang tight with that. Before we go, Stephen, just your thoughts on Asian currencies. We talk about higher yields right now. How might that impact the rest of the Asian currencies?
It's kind of pretty much the same theme as over the last year. So in Asia, the higher yielders may be more resilient against the dollar. So again, namely Philippines, Indonesia, and India. I mean, especially in the case of Philippines and India, it's very interesting because their currencies against the dollar and approaching record lows again. So you can see more forceful wordings from the BSP, from the RBI, and they may actually act upon it if the currency continues to weaken. So these high yielders plus the intervention risk will actually support these currencies. But for the rest of Asia, the low yielders, talking about Thai baht, South Korean won, and Taiwan dollar, could be hurt more if the higher yield US dollar strength story continues.